Hello, and welcome to this week's Profit Maximizer Moment. This show is dedicated to helping business owners dramatically improve their bottom line with our weekly profit maximizing tips that you can use now. I'm your host and coach, Wayne Belisle. I'm also the founder of a local CPA firm that works with business owners to help them make more money and keep more of it from the IRS. I do that with our profit coaching programs and with our tax planning system, which has saved our clients well over $7 million now, all legally. We like our clients, but we don't like to share a jail cell with them. Today, we're going to continue our tax planning process, our tax planning courses, because it's tax planning time. Of course, if you haven't filed your personal tax return or year-end C Corp, you got till October 17th. It's probably already too late to get somebody to do it for you, but you could try. Okay. In this one, we're going to talk about year-end tax tips that can save your personal families, your personal tax return, I'm assuming with your family, thousands of dollars. Okay. But before we get to that, today's show, forgot to get ready, is brought to you by Profit Maximizing Publishing, which published our book, The 30-Day Profit Reset, which shows you how to gain your independence from reduced cash flow, shrinking margins, and evaporating customer base. In this book, you will find chapter after chapter, idea after idea about how you can turn around your business, reset your profits from red to black in 90 days or fewer. All right. Sorry, man. It's change of weather, which I like. Fall's my favorite time in El Paso. It's pretty much my favorite time, no matter where you're at. Okay. So, look. 2 weeks ago, well, this is the fourth in this series. Okay, so the first one was why you need to do tax planning. Second was tax planning for business owners. Third one was, where's the camera? Tax planning for real estate. This is kind of the final on this, though I have one more for next week, which is important. So, you know, how to help your tax preparer save you thousands. Okay. Look, if you don't own a business and you don't own rental properties, not a lot you can do. All right, let's be honest. There's a limit, and this is not accidental. They've been trying to do this forever. They've been slowly chipping away at itemized deductions, and now with the standard deduction being so much higher, it really is, I'd say, less than 5%, maybe 5 to 10%, possibly, are itemizing. The rest aren't. You got limits on donation. I'm sorry, you got limits on state and local taxes, what you've heard probably referred to as salt taxes, and then you have limitations on medical. So it makes it pretty hard. So one of the main things that you can probably do is, if you're working for somebody that has a 401k or a simple, max it out, or at least get something in it, because it's one of the last things left for you that, whether you itemize or not, you get to do. If you have yourself or somebody going to college, make sure you maximize the credit in your first 4 years, the American Opportunity Credit. Be careful. Tends to get, it phases out if your income's too high. So sometimes it might make more sense for your child to claim themselves and take the credit. Not always. In low income years, consider converting a regular IRA to a Roth IRA so that the hit won't hurt you as bad. Future distributions from a Roth would be tax-free. If you itemize, if you're one of the ones that itemize, clean up your garage, closet, sheds, make a donation to Goodwill or a similar organization. Donations must be in good or better condition. Get a receipt. I highly recommend taking pictures in front of the Goodwill sign or something to support the deduction. An alternative, it's not a tax tip, but have a yard sale. All right. Items are usually sold below cost, so the money you get is going to be tax-free. You can't deduct personal losses, so it won't work. If you do itemize, prepay medical expenses by December 31st. If you don't have the money sticking on a credit card, that's considered as if you paid it in that year. Okay. Track your medical and mileage and your medical and contribution mileage. If you are able to itemize and you do those two things, make sure there's a lot of money that can be done there. If you're falling short of the itemized level, but you're close, you might want to consider bundling and itemizing every 2 years. Okay, so take the standard deduction in 1 year and itemize in the next. And two places that you can easily do that: if your house is paid off, or if you're refinancing and you have to pay your own property taxes, then pay 2 years in one. So in other words, like El Paso, it's due December 31st. Sorry, it's due January 31st. In 1 year, I can make the payment in January. For the next year's taxes, I can do it at the end of December. So I have two property taxes. May not help because of the limitation. But one of the better ways, though, is contributions. Maybe make all the contributions in 1 year or the next. It's possible. It's not as easy as it used to be. If you're thinking about a car next year, consider buying it before the end of the year. Of course, again, it may not help you as much because of the SALT limitation. If you have losses on stocks and mutual funds, consider selling stock investments with a large amount of unrealized gain in order to use these losses. Check with your tax advisor and check with your financial advisor, okay? As long as it makes financial sense and fits your financial goals, sell any stocks in a loss position you might have in order to offset capital gains you may have from the sale of other investments. If you have losses from prior years, consider selling stocks that have built-in gains to use these losses, okay? If you're replacing sold stock, though, remember, if you buy the same stock within 30 days, you won't be able to get it. It's called a wash sale. So maybe you buy a similar company in the same industry. Anyways, that one, I don't know why I wrote that one down. If you need to assist your parents or your children, don't sell stocks and then gift them the cash from the sale. Instead, gift them the stock and let them sell the stocks. Assuming they are in a lower tax bracket, they'll pay taxes at a lower rate, maybe even a zero tax rate. Okay. If you're going to make donations to a charity, consider donating appreciated stock rather than cash. Again, the donation of appreciated stock gives you more of a tax benefit. All right. Invest in tax-free municipal bonds if they make sense for you. They're usually tax-free from federal and state and local taxes. If your taxable income from investments that you will not use to live on anytime soon, like if you got a lot of interest income, a lot of dividend income, get with your financial advisor and see if an annuity makes sense for you where it'll grow tax-free until you take it out. Maximize your student loan interest deduction. Pay off some of your student loans. If you're getting hit with the alternative minimum tax, get with a tax advisor and see if there's something you can do to help reduce that. Make sure you audit proof your deductions. Anything you have, you should have backup for. All right. So make sure you have, because the IRS really does follow a simple rule. If it isn't written down, it didn't happen. And even if it's written down, if it's not from a third party, it probably didn't happen. So make sure you back that up. If you and your siblings all support a parent, but none of you do more than 50%, you should explore how you can take that deduction. There's a way for each of you to elect to decide who gets to claim them. As long as the group of you provide more than 50% of the support, but nobody provides 50%, then you can do that. One of the other things you can really look at that makes a lot of sense is the health savings account. You probably aren't going to be able to deduct your your medical expenses, but you can put money in a health savings account. It reduces your taxable income now. You usually get a debit card or something that can pay your co-pays, your medicine, but it also carries forward from year to year. So as you get older, trust me, you're going to have more medical expenses. Beware of the new additional, well, it's not new anymore, 0.9% Medicare tax. This came under Obamacare. If your income was high enough, you got hit with it. So be careful. Plan on it. If your income fluctuates, you can probably time it so you don't get hit with that. Consider renting out a portion of your principal residence or a second home for fewer than 15 days. That becomes tax-free. Be sure to look at alimony payments. Okay, I'm seeing a lot of people missing this because after 2018, you weren't allowed to deduct it. But if you have a divorce decree before 2018, you do get to deduct the alimony payments. So don't forget them. Home equity loans aren't taxable anymore. Are not deductible anymore. So if you have one on your personal home, you just won't be able to use it. But if you have a rental property, maybe it makes sense if you have rental properties that you can refinance that have some equity in them, go ahead and do that and pay off your personal home, because your personal home interest is probably not going to be deductible, and especially if it's an equity loan. So consider that. There's not much more. If you do expenses out of personal, for business, and you get reimbursed or don't get reimbursed by your employer, you no longer can do that. That stopped after 2018. So one thing to do is to work with your employer and see if you can set up what's called an accountable plan, which means you turn in receipts, they reimburse you for it. The company gets to deduct those expenses. But since you got reimbursed on an accountable plan, you do not have to pick them up as income. A lot here, but not as much as in the prior 2 weeks because there's just not as much you can do anymore. And it's by design. All right. Next week, stay with us. We're going to be finish up our series with 5 steps that help your tax preparers save you money. Help us. It's amazing how hard we have to work sometimes to help our clients. Hey, until next time, this is Wayne Blau saying let's make this our most profitable year ever. Thank you very much.